The 3 outside up pattern is a crucial formation in trading, indicating a potential bullish continuation or reversal. This pattern forms over 3 days of trading activity. On the first day, a bearish candlestick appears, followed by a bullish candlestick on the second day that completely engulfs the first day's candlestick. The third day confirms the pattern with another bullish candlestick, ideally closing higher than the second day's close. This sequence suggests a shift in market sentiment from bearish to bullish, making it a signal for traders to consider entering long positions or closing short positions. The significance of the 3 outside up pattern lies in its ability to signal a strong bullish reversal or continuation, helping traders identify potential entry points for buying. It is especially reliable when it occurs after a downtrend or within a context that supports a reversal, such as oversold conditions. We encourage traders to practice identifying and interpreting the 3 outside up pattern in their trading activities. Familiarity with this pattern, alongside other technical analysis tools, can sharpen decision-making skills and enhance the ability to spot profitable opportunities in the markets. In conclusion, the dynamic world of trading requires continuous learning and adaptability. Understanding patterns like the 3 outside up is part of a broader strategy to navigate market complexities. Traders should remain open to new information and strategies, continuously refining their skills to stay ahead in the ever-changing market environment. Candlestick patterns are crucial tools in technical analysis, providing key insights into market sentiment. These patterns are formed by the price movements of securities depicted graphically on charts. Each candlestick represents price action for a specific time frame, showing the open, high, low, and close prices during that period. Traders rely on these patterns to make predictions about future price movements based on past trends. The 3 outside down pattern is a significant bearish formation, typically signaling a shift in market dynamics. It is composed of 3 specific candlesticks. The pattern begins with a large white or green candlestick, indicating a day of gains. This is immediately followed by a larger black or red candlestick that closes below the prior day's opening, showing a strong reversal of the bullish trend. The sequence concludes with a third candlestick that reinforces the bearish trend, closing even lower than the second candlestick. This pattern can often be a precursor to a continuation of a downtrend or could signal an impending market reversal. Understanding the 3 outside down pattern is essential for traders looking to capitalize on bearish market trends. By recognizing these patterns early, traders can adjust their strategies to either mitigate losses in a bearish market or to leverage potential profit opportunities by short selling. The 3 outside down pattern is a formation found in candlestick charting, often interpreted as a bearish signal indicating the potential for a continuation or reversal of the existing downward trend. To visualize and understand this pattern, picture 3 specific candles on a stock chart. 1. The first candle is large and bullish, meaning it has closed higher than its opening price. This candle is typically part of a prevailing uptrend, standing out with its solid body occupying a significant portion of the price range. Imagine this as a bright day in the market where buyers have been firmly in control. 2. The second candle opens higher than the close of the first candle, which might initially suggest continuing bullish sentiment. However, the pattern takes a turn as this candle closes well into the body of the first candle. This is a bearish engulfing candlestick, signaling a shift in momentum where sellers have overwhelmed the buyers. Visualize this as a day that starts with hope for the bulls but ends in favor of the bears. 3. The third candle confirms the bearish sentiment by closing lower than the previous candle, ideally below the body of the first candle. This seals the bearish reversal or continuation pattern, portraying a scene where sellers dominate the market for a consecutive session, thereby pushing the prices further down. In various market scenarios, the appearance of the 3 outside down pattern suggests that after a period of upward movement or consolidation, the sellers have gained significant strength, possibly leading to further declines. It's akin to watching dark clouds gather, suggesting an impending storm might upset a previously sunny market landscape. This candlestick pattern is seen as a reliable indicator for those anticipating a shift in market direction, especially when it occurs after a strong uptrend or at resistance levels. To apply this knowledge, investors and traders look for confirmation in the form of additional bearish candles or through technical indicators to reinforce the potential downtrend before making decisions. The 3 outside down is a technical analysis chart pattern used to predict the reversal of the current uptrend in market prices. It consists of a specific sequence of 3 candlesticks which reveal a shift in market sentiment from bullish to bearish. The first candlestick is large and green, indicating that the price closed higher than it opened, which is characteristic of ongoing bullish market conditions. The second candlestick opens higher but then closes below the opening price of the first candle, and it is red, signifying the beginning of bearish sentiment. The third candlestick further confirms the bearish trend by being red as well and closing even lower than the second candle, solidifying the reversal signal. The positioning of this pattern within a trend is crucial for its accurate interpretation. It should appear after a noticeable uptrend, indicating that the bullish momentum is losing strength and a potential downward movement may be imminent. Traders and analysts pay close attention to where the 3 outside down pattern forms in relation to previous price movements to validate its significance as a trend reversal signal. To illustrate real instances of 3 outside down patterns, envision charts where after a period of consistent upward movement, showing green candlesticks increasing in height, the pattern emerges. The decline starts subtly with a long green candle followed by a larger red candle dipping below the first candle's opening. The pattern is solidified by a third red candle closing even lower, all highlighting a stark contrast against the prior uptrend. Understanding and identifying the 3 outside down pattern involves not just recognizing its shape, size, and color, but also interpreting its position within a trend for accurate forecasting. Detecting this pattern enables traders to adjust their strategies, potentially shifting from holding or buying positions to preparing for a sell-off based on the anticipated reversal of the current uptrend. The 3 outside down pattern is a significant indicator in technical analysis that suggests a negative shift in market sentiment and trader psychology. This pattern emerges over 3 candlesticks during an uptrend. It starts with a large bullish candle, followed by a bearish candle that closes lower than the bullish candle's open, and a third candle that closes even lower, reinforcing the bearish trend. When traders observe the formation of the 3 outside down pattern, it reflects a strong shift in momentum from bullish to bearish sentiment. This change signifies that sellers are gaining control over the market, overpowering the buyers who previously drove the market's upward trajectory. The initial bullish candle suggests a continuation of the uptrend, but the following two bearish candles challenge this assumption and indicate that the trend may be reversing or at least weakening. The significance of this pattern lies not just in the change of direction, but also in the psychological impact on traders. The swift change from a bullish to a bearish outlook causes uncertainty among traders who are betting on continued upward movement. Those holding long positions might start selling their assets to cut losses, further driving the price down, while short sellers might see this as an opportunity to enter the market, betting on the continuing downward trend. Therefore, the three outside down pattern is more than just a signal of potential trend reversal or continuation. It is a manifestation of the changing tide in market sentiment, pointing to the increasing bearish strength and a possible shift in the momentum that can guide traders in making more informed decisions. The three outside down pattern is a bearish candlestick formation that can signal a potential reversal or continuation of the current trend, depending on the context in which it appears. To understand how this pattern works, let us break down its characteristics. The pattern starts with a bullish candle, suggesting that the current trend is upward. Immediately following this, there is a larger bearish candle that engulfs the body of the previous bullish candle, indicating that selling pressure has overcome buying pressure. The third candle in the sequence is another bearish candle that closes lower than the second, reinforcing the bearish sentiment. When this pattern occurs during an uptrend, it is often interpreted as a reversal signal, indicating that the trend may change from bullish to bearish. This is because the bears have successfully taken control, pushing the price down and potentially starting a new downward trend. However, if the three outside down pattern appears during a downtrend, it can act as a continuation pattern, suggesting that the downtrend is likely to persist. This happens because the pattern confirms that sellers are still in control, driving prices even lower. Illustrating this with chart examples, imagine a scenario where the market has been experiencing a steady uptrend. Suddenly, a three outside down pattern appears. The first candle is small and bullish, but it is quickly followed by a larger bearish candle that completely engulfs the first one. The third candle continues the downward movement. In this context, the appearance of the three outside down pattern would strongly suggest that the uptrend might be reversing and that a new downtrend could be beginning. Conversely, in a market that has been trending downwards, the appearance of the three outside down pattern reaffirms the bearish sentiment. The first bullish candle might give hope to buyers, but the following bearish engulfing candle and the subsequent lower close extinguish that hope, reinforcing the strength of the ongoing downtrend. The importance of context cannot be overstated when interpreting the three outside down pattern. Market conditions, volume data, and other technical indicators should be considered to confirm the pattern's implications. Traders often look for additional confirmation through indicators like moving averages, relative strength index (RSI), or volume analysis to make more informed decisions. In summary, the three outside down pattern is versatile, serving as a potential signal for both trend reversals and continuations. Its significance is greatly enhanced by the market context and should be validated with complementary technical analysis to guide trading and investment decisions effectively. The three outside down is recognized as a bearish continuation or reversal pattern that traders monitor closely in the stock market. To validate the implications of this pattern, several additional indicators and conditions can play a crucial role. These include trading volume, nearby resistance levels, and the trend preceding the pattern. Firstly, trading volume is a significant indicator that can reinforce the signal provided by the 3 outside down pattern. An increase in trading volume on the days when the pattern is formed suggests strong participation in the bearish move, thus providing further confirmation of the pattern's validity. On the other hand, if the trading volume decreases or remains low, it might indicate a lack of conviction among traders, potentially weakening the significance of the pattern. Secondly, nearby resistance levels can also impact the interpretation of the 3 outside down pattern. If the pattern forms near a significant level of resistance that has historically proven difficult to breach, it may suggest that the market is struggling to move higher and is likely to continue its downward trend. Conversely, if there is no significant resistance near the pattern, the bearish reversal or continuation signal might not be as strong. Lastly, the trend preceding the 3 outside down pattern is crucial for its interpretation. A pattern that appears after a prolonged uptrend may signal a potent reversal, as it indicates that the bullish momentum is waning and bears are taking control. However, if the pattern emerges during a downtrend, it may simply signify a continuation of the existing bearish trend, thus affirming the strength of the downward movement without necessarily indicating a stronger reversal signal. In essence, when these additional factors, trading volume, nearby resistance levels, and the preceding trend align with the 3 outside down pattern, they can substantially reinforce its bearish implications. Conversely, if these factors do not support the pattern, they can weaken its significance, making it crucial for traders to consider a holistic view of the market conditions before making trading decisions based on this pattern. The 3 outside down pattern is recognized for its role in signaling changes in market direction, typically indicating a bearish reversal when it appears after an uptrend. However, assessing the historical accuracy of this pattern in forecasting market movements requires a nuanced understanding. While the pattern can be a reliable indicator, its effectiveness varies across different markets and time frames. It has shown notable accuracy in certain contexts, but is not infallible. One of the key limitations of the 3 outside down pattern, like many technical analysis tools, is its dependency on historical data. This reliance means that it can sometimes lag behind real-time market changes. Moreover, the pattern's predictive power can be influenced by market volatility and the presence of other conflicting signals. Given these limitations, it is crucial for analysts and investors to use the 3 outside down pattern in conjunction with other analytical tools. Incorporating fundamentals of the underlying assets, broader market indicators, and perhaps even elements of behavioral finance can provide a more holistic view of market dynamics. This approach allows investors to validate signals provided by the pattern and to apply a more comprehensive risk management strategy. By integrating different analysis methods, investors can enhance the reliability of their market forecasts and make more informed investment decisions. Integrating the 3 outside down pattern with other technical analysis tools such as the Relative Strength Index, RSI, Moving Average Convergence, Divergence, MACD, or Fibonacci retracements can enhance trading decision-making by offering a more comprehensive view of the market. The 3 outside down pattern is a bearish reversal or continuation pattern that signals potential downward movement in the market. When combined with other indicators, it can provide a clearer confirmation of the market's direction. For instance, when observing a 3 outside down pattern, one can also look at the RSI to gauge whether the asset is in the overbought territory, generally above a reading of 70. An overbought condition coupled with the pattern could suggest a stronger bearish reversal. Alternatively, the MACD, which measures the momentum of an asset, can offer insights into the strength of the bearish move. A bearish crossover on the MACD, occurring when the MACD line crosses below the signal line, can confirm the bearish sentiment indicated by the 3 outside down pattern. Moreover, Fibonacci retracements can identify potential levels of support and resistance following the formation of the pattern. If the price action following a 3 outside down pattern retraces to and then bounces off a key Fibonacci level such as 61.8%, this might confirm the continuation of a bearish trend. An example of how this integration can enhance trading decision making might involve a trader observing a 3 outside down pattern on a stock chart. The trader also notices that the RSI is above 70, indicating the stock is potentially overbought. The MACD shows a recent bearish crossover. Based on this combination of signals, the trader decides to enter a short position, anticipating a continuation of the bearish trend. Subsequently, if the price action reaches a Fibonacci retracement level and starts to decline, the trader may use this as an additional confirmation of the downtrend, potentially adjusting their trading strategy to maximize gains or minimize losses. In conclusion, by integrating the 3 outside down pattern with other technical analysis tools like the RSI, MACD, and Fibonacci retracements, traders can make more informed decisions. This combination of tools enables a multifaceted view of market conditions, providing stronger signals for entering or exiting trades, ultimately aiming to improve the profitability and efficiency of trading strategies. Traders often encounter common errors and misconceptions when interpreting the 3 outside down pattern, which can impact their market decisions. Understanding these mistakes and learning how to avoid them is crucial for improving pattern recognition and analytical skills. One prevalent mistake is assuming that the appearance of a 3 outside down pattern always signifies a bearish reversal. While it commonly indicates a potential bearish turn in the market, other factors such as market context, volume, and adjacent patterns should also be considered. Without taking these into account, traders may act prematurely or misinterpret the signal's strength. Another error is overlooking the importance of volume. For the 3 outside down pattern to be considered more reliable, it should be accompanied by higher trading volume on the days of the pattern. Some traders neglect this aspect, which can lead to misjudging the pattern's validity and potential impact. Additionally, traders sometimes fail to differentiate between a short-term correction and a long-term trend reversal. The 3 outside down pattern might signal a temporary pullback in an overall uptrend rather than a complete trend reversal. Recognizing the broader market trend is essential to interpreting the pattern correctly. To avoid these mistakes and enhance pattern recognition, 1. Analyze the pattern within the context of the current market environment. Look beyond the pattern itself and consider overall market trends, news, and economic indicators. 2. Pay attention to trading volume. A significant increase in volume on the days forming the pattern can add credibility to the signal. 3. Combine the use of the 3 outside down pattern with other technical analysis tools. Support and resistance levels, moving averages, and momentum indicators can provide additional insights and help confirm or refute the potential bearish signal. 4. Practice patience and wait for further confirmation. Instead of acting on the appearance of the pattern alone, wait for additional signals that confirm the market's direction. Improving analytical skills requires continuous learning and practice. By understanding common mistakes and applying a comprehensive approach to market analysis, traders can make more informed decisions and enhance their trading strategies. The 3 outside down is a technical analysis pattern that traders use to predict bearish market movements. Understanding how to incorporate this pattern into trading strategies requires an appreciation of its components and implications. Here's how traders can approach setting entry and exit points using this pattern, followed by a case study that illustrates its practical application. Strategies for using the 3 outside down for trading decisions. 1. Identification. The pattern consists of 3 candles. It starts with a bullish candle, followed by a larger bearish candle that envelops the first one, and completes with another bearish candle that closes lower than the second one's close. Recognizing this pattern is crucial for deploying it in trading strategies. 2. Entry points. The completion of the 3 outside down pattern signals a potential bearish reversal if it occurs at the end of an uptrend or a bearish continuation in a downtrend. Traders often wait until the 3rd candle closes to confirm the pattern before considering a short position. An additional confirmation might come from other indicators such as moving averages or relative strength index (RSI) to reinforce the decision. 3. Exit points. Setting exit points after entering a trade based on the 3 outside down can involve several approaches. A common strategy is to place a stop loss just above the highest point of the pattern to limit potential losses if the market moves against the position. Profit targets could be set based on key support levels below the current price or using a risk-reward ratio that aligns with the trader's risk management strategy. Case study. Consider a trader monitoring a stock exhibiting a strong uptrend. Upon noticing a 3 outside down pattern forming at a resistance level alongside an overbought signal from the RSI, the trader decides to enter a short position at the close of the 3rd candle of the pattern. By setting a stop loss slightly above the pattern's high and aiming for a profit target at the next significant support level, the trader manages risk while capitalizing on the anticipated downward move. The trade succeeds as the market moves lower in the following sessions, validating the bearish signal provided by the 3 outside down pattern. This case underscores the value of combining pattern recognition with other technical indicators and sound risk management in executing successful trades. This example demonstrates that employing the 3 outside down pattern for trade decisions involves careful observation, pattern confirmation, and strategic planning regarding entry and exit points. Coupling this approach with additional market analysis tools enhances the likelihood of making informed trading decisions. The 3 outside down pattern is a reversal signal in technical analysis that indicates a potential shift from an uptrend to a downtrend. This pattern involves 3 candles on a chart. To understand variations and similar patterns, let's explore how they compare and what unique trading implications they have. Firstly, the 3 inside up and 3 inside down patterns are closely related to the 3 outside down pattern. The 3 inside up pattern is a bullish reversal signal consisting of a large bearish candle followed by a candle that trades within the range of the first candle and closes higher, and a third candle that closes above the high of the first candle. This pattern suggests that buyers are gaining control. In contrast, the 3 inside down pattern is bearish, starting with a bullish candle and followed by a candle that trades within its range but closes lower, signaling that sellers are taking over. Another variation is the 2 crows pattern, which is similar but consists of only 2 candles. In this pattern, the market is in an uptrend and the first candle is long and bullish. The second candle then opens higher but closes within the body of the first candle, indicating that the uptrend may be losing momentum. The engulfing pattern, either bullish or bearish, is another similar setup. A bearish engulfing pattern occurs when a small bullish candle is followed by a large bearish candle that completely engulfs the body of the previous candle. This pattern suggests a strong shift in sentiment from buying to selling pressure. When analyzing these patterns, traders look for specific chart attributes. For example, in a 3 outside down pattern, the first candle is bullish within an uptrend, followed by a larger bearish candle that engulfs the first one, and a third bearish candle that confirms the reversal by closing lower than the second candle's close. Traders interpret this as a strong sign of a potential reversal. Understanding these patterns requires visualizing them on a chart. For instance, imagine a sequence of candles on a chart where each pattern forms over several sessions, reflecting shifts in market sentiment and potential trend reversals. The 3 outside down pattern, with its strict conditions of a preceding uptrend, followed by a bearish engulfing candle and a confirmation bearish candle, is distinct in signaling an upcoming downtrend. Each pattern, with its specific formation and context, offers traders insights into potential market movements. By comparing the observed patterns to historical trends, traders can make more informed decisions on whether to enter or exit positions, always considering the broader market context to avoid false signals.